Good afternoon, everybody. We'll wait for everybody to really get us filtering in here. I see we're about 108 people thus far and counting. Excellent. All righty. Well, welcome. Welcome to the Tri-University Research Administration Conference. I'm sure you've been through some awesome sessions today. We'll let some more people come in. Well, lots of people, guys. Excellent. Really great numbers. Almost 220. Yes. Excellent. All right, so here we are. Welcome. Welcome everybody to Budgeting and Spending 201. We're going to go through some housekeeping things first before we actually get started with the presentation. So if you have issues with Zoom troubleshooting, as you see here, issues with audio, verify your microphone and speakers, set the appropriate devices, turn off your headset and computer speakers, and or call in by audio via phone. So that's also another option. If there's any general issues, try logging out and going back in through your SSO. And if there's technical support, there is a number to call right there. So today's session will be recorded and will be made available later on for your viewing pleasure. There is closed captioning. It is a live transcript feature and it's been enabled so we can read everything that's being said. And at the end, we'd love your feedback on this session. You'll receive a Qualtrics survey link. It'll take 2 or 3 minutes to provide the actual information on the survey, and your feedback is really important for us for continuous improvement of the Tri-University Research Administration Conference, otherwise known as the TURAC. And with that, I believe we will get going, shall we?
Indeed.
Hello, everyone, and welcome. So I did want to take a moment to just remind everybody that all 3 universities do have different statements when it comes to land acknowledgement. The prior session, I read ASUs, so for this one, I'm going to do NAUs. Northern Arizona University sits at the base of San Francisco Peaks on homelands sacred to Native Americans throughout the region. We honor their past, present, and future generations who have lived here for millennia and will forever call this place home.
Thanks, Sam. And welcome to Budgeting and Spending 201, and welcome back if you were just previously in 101. We are, in fact, the same presenters.
So I'm going to pretend that these are all new people. Hi, I'm Sam Munguia. I'm Assistant Director of Research Advancement for W.P. Carey School of Business here at Arizona State University. I have done pre-award, post-award, grant writing, have been doing it for the last 18 years. I have worked collectively for ASU for about 8 years, but I have also worked for the University of Arizona. Prior to my current position, I was a grant and contract officer principal with our central office of sponsored project, more specifically with the fiscal oversight team, where I focused on expenditure monitoring. And just a fun fact about me, me and a couple colleagues just recently submitted a proposal to the National Science Foundation, where I served as a PI. So I have done a little bit of everything when it comes to research administration.
And I'll start by saying I have no fun facts, but I can present myself as my position, which is pre-award manager. I work with the Office of Research and Sponsored Projects Administration at ASU. I'm with the Proposals and Negotiation team, and my group reviews and authorizes and submits proposals for the university. I went to ASU as a student and have worked here for a good bit of my research administrative life, which is mainly in pre-award. Okay. So here are our session objectives. We are going to move pretty rapidly through the beginning part of this presentation because we have some good case studies at the end. So forgive the pace, but hopefully we'll be able to address everything that you are curious about, and those things that we don't address, please go ahead, put in the chat. If we run out of time, we'll get to your questions, of course, when the presentation materials are uploaded. All right, so a reminder, when we're accepting a sponsored project, the principal investigators and the university agree to follow the cost policies defined by the sponsoring agency. In budgeting and spending for sponsored projects, the PI assures the university and the sponsor that the costs are accurately represented. Unless identified as the individual or PI, the applicant in this presentation is going to refer to the university. So our session starts by expanding on the governing policies and how that impacts budgeting. The focus here will be on subpart E of uniform guidance, which is the cost principles as it drives our budget determinations. So within subpart E, cost principles under basic considerations, you'll find factors affecting allowability of costs. The federal cost principles must be applied uniformly to all federal awards and must be consistent with policies and procedures that apply to federal awards and other activities in the university. That includes non-federally supported programs. So further, in subpart D, which deals with post-award requirements, that stipulates that grantees must have written procedures for determining the allowability of costs in accordance with the cost principles and the terms and conditions of the award. So you may be familiar with the items of cost here. That's from Uniform Guidance. It clarifies allowability of certain items, but it is not exhaustive. And further, it's ultimately qualified under the basic considerations which apply to all costs, whether or not they're mentioned on this list. So the purpose of the cost needs to be tied to a specific research objective. It must be clearly identified in the justification, along with its necessity to execute the project. The justification allows the sponsor to review and qualify the need for the cost, and further, the justification and the subsequent approval prevent questions regarding allowability, right, during an audit and the award stage. So we're going to look really quick at entertainment, right, which we all recognize is generally unallowable cost. But here we have a case where a PI would like to buy tickets to a D-backs game, right, which I hope all of you are joining the D-backs and snacks later today. He's proposing to the Department of Education. The purpose of the program is for cultural immersion of overseas students. Is this allowable? It's identified in the justification. It's supporting the population that's being served by the program, and it's specifically tied to the objectives that sponsor has laid out. So it may be considered an allowable expense here, right? However, if that same PI wants to book the pool to give his project personnel some sort of reward for doing well on the project, well, no, that does not serve the research objective. So beyond the measure of prudence and acting without influence, the applicant must be able to prove that there's no significant deviation from established policy. So for example, if you have a budget that has costs for an offsite meeting, it's justified as necessary for the delivery of grant services. It's assuring broader access, right, to project stakeholders. However, the reviewer finds, right, that the meeting itself is on some sort of beachside resort, right, but the project is based in Tucson. Well, then the costs are going to be disallowed as unreasonable and therefore not necessary to carry out the award. And then, of course, allocability. Can the proposed cost be specifically assignable to the project? In pre-award terms, at least, this is a critical element of the direct versus indirect cost determination. So is the expense a direct benefit to the grant? Can it be easily and accurately traced? And if it benefits more than one grant, have you calculated the proportional benefit? So understanding these concepts and recognizing where your own institutional policies are in play will better equip you to include those costs and ultimately defend them, right, for the need of the conducted research. As it relates to estimating costs, consistency relies on a dedicated application of your institutional policies, and reasonableness requires that you're able to authenticate the cost if called upon. And of course, allocability is a demonstration of how the costs conform to the limitations within the hierarchy of those governing policies. So here, of course, we just have an example on the left-hand side of different areas of estimation in which you will want to apply your institutional policies. Again, it's just appropriate or important rather that they be consistent. Of course, we talked a little bit about the cost accounting standards and those exceptions in 101. Really here, you just want to make sure, I mean, it was described there, I'll do so really quickly here. Basically, this is to ensure the consistent treatment of the allocation of direct and indirect costs. You can't basically charge something in both categories there, right? So an exception is for something that would conventionally be covered under F&A, right? But it is in such need, right? So specific to the project or what they call unlike circumstance, right? That you would be able to justify it and include it as a direct cost, as you should if it meets those qualifications. Just make sure to justify it appropriately. Okay, so now we're going to really jump into these additional cost considerations and categorical cost identifications. Workforce, we talked about personnel quite a bit in 101. Workforce, here we go a little bit more into employees, stipends, supplemental pay, and subawards. The graduate RAs or GRAs, And hourly student wages are usually defined by your own department policy and usually must meet an established minimum. Tuition costs are relative to GRA effort if there's tuition remission involved, and they can be calculated differently between summer and academic months. A note about stipends. Those don't use tuition remission figures if the student is receiving a stipend, but actual tuition, which depends on their residency. With stipends, the role of the student on the project is going to inform the method of payment. For non-compensatory stipends, they can't require the student to perform services. For sponsored projects, this means that the student performs the project in benefit of themselves and not the project. If the payment is issued as non-compensatory and is later found to be compensatory, then the student might incur some tax liabilities, which usually lands on the department. And just a note that PIs can refer to stipends as a catch-all for all student support. So just make sure that you're identifying or distinguishing that, right? Because it is important that you budget appropriately. Inter-university consultancy or additional or supplemental pay. It's very limited. This is compensation for activity that's beyond normal job duties and is done so outside of the regularly scheduled workday. Each university will detail these qualifications, but in every case, it needs to be approved by the sponsoring agency, and ultimately it has to be authorized by the university before they issue any payment. And then, of course, regardless of type, subawardees need to be able to substantiate their costs, and then depending on the size of the award, are going to undergo some sort of form of cost analysis. So it is the prime applicant's responsibility to ensure a subrecipient's costs are compliant with sponsor policy. And of course, just like we do, they'll have their own institutional methods of estimation, but they should be able to substantiate their costs. Fellowships. These are grants that support educational experience for the recipient. They are not considered compensation for performance. The purpose is to enhance their academic experience or career growth. And so this is funded as non-compensatory. Some fellowships are actually applied for and then managed by the individual themselves, but for those that require institutional oversight, we do treat those or process those like sponsored projects. They are typically categorized as student aid and therefore are not subject to F&A. However, there are cases where there are F&A eligible research activities associated with the fellowships. So make sure that you do budget those and separate those accordingly. All right, we talked about a capital equipment item of having a unit cost of $5,000 or more and a life of a year or more. Fabricated equipment, of course, is a finished product of $5,000 or more. It's constructed from individual parts to make an identifiable and discrete item. University of Arizona offers an example of a telescope that's composed of a computer, a camera, a lens, etc. Right? Makes its own unique item. ASU has an example of a car where the engine, converts energy. The frame has structure. The wheels reduce friction, I believe they say, but the car itself provides transportation. It's its own discrete item. And a note, we are actually reiterating this because it is quite important. The parts that are not integral and permanent as part of the system, right, the resulting system, the unique item, those aren't included in fabricated costs and should be included in the appropriate expenditure category. Oftentimes it's supplies.
Sarah, and before I forget, no, I know we talked about fabricated equipment on the previous session, but one thing I did want to bring up about the importance of, getting quotes and the right information at proposal time, especially with fabricated equipment. Here at ASU, we had an instance where, faculty based on their technical expertise deemed particular elements of fabricated equipment to be integral for that piece of equipment, and it was capitalized at purchase time, but then when financial services did an audit of newly fabricated equipment in the assets system, they advised against it, and so they decapitalized all of those purchases, and now the department was left struggling trying to figure out how to pay for the F&A now that that piece of equipment was no longer considered capital equipment. So depending on the restrictions of your institution, if it is worthwhile to maybe loop in your assets management team and get a second look before you put it on your proposal. Just something to be aware of with fabricated equipment. If not everyone agrees on that definition when you're buying things, you end up holding the bill for that F&A that you're going to have to pay.
That's excellent advice and good general advice. I mean, the F&A is going to be there whether you are prepared for it or not, right? You'll be on the hook for it. All right, conferences. So grant funds may be used to host a meeting or a conference, of course, if it's consistent with the approved application and necessary to achieve the goals of the grant. Make sure you know where it's taking place. Facilities that are offsite are not subject to F&A. Costs associated with intra-campus or interdepartmental meetings are unallowable as the conference costs. Because as uniform guidance defines, conferences need to have the primary purpose of disseminating technical information beyond the non-federal entity. That's you as the applicant. Lunch meetings with collaborators and departmental retreats are also unallowable. They do not satisfy that definition either. So budgeting food, it again can be allowable, right? Unless there's explicit sponsor restriction, of course. But if the food is necessary to complete the scope of work, which should be clear in the budget justification, then it is permissible, and you should be budgeting it if it's a required part of the project, right? Because of the scrutiny, however, applied to this cost, just make sure that you are documenting during the award to show that the activity is directly related to the project. And then attendee tokens, those are usually branded supplies that they distribute at conferences. Again, they must be justified using the cost principles that we just talked about, and then they can be allowable. So for individual dues, memberships, subscriptions, or professional activities, they may be permitted if it's a direct benefit to the project or in support of career development, if that's the aim of the sponsor's program. But of course, membership fees such as airline memberships or social clubs, those cannot be charged. You may find that memberships also mean something different. They may be fees paid to a sponsor in exchange for institutional affiliation and those associated benefits. The sponsor will say as much. They will define the price of that membership and the payment obligations for that. But if you see that, it's important to note whether that membership fee or the membership itself is a requirement either to apply or a condition of funding. Your institution will generally determine the responsible party for this cost, right? Whether it's a lead financial unit, because they're the ones that are receiving the benefit, or if it's broader and an institutional responsibility. Quick note, those fees cannot be budgeted as part of the proposal, unfortunately. So you can't wrap that into the actual submission for that program. All right, data protection. So this is specific to DoD in this case. When you see the safeguarding of unclassified controlled technical information, aka NIST 800-171. This, if you see this, if this is a requirement, you should be including funds for additional secured storage. You may have also seen CMMC, the Cybersecurity Maturity Model Certification, and this is a framework that DoD is implementing actually pretty soon here, and it is based on the NIST 800-171. There's a couple levels there. There's a foundational level, level 1, which we try to push in terms of us performing fundamental research, and therefore we can accommodate with our current safeguards. But the CMMC level 2, that's advanced. That's equivalent to that NIST 800-171. So again, this is just to protect your budget in such a way that you are including these costs. If you see these requirements in the solicitation, we do everything we can to declare at the pre-award stage that our research will fall under fundamental research, and therefore that higher level of security, that CMMC 2 level, should not apply. But if it does anyways, that we will be asking for money, essentially. All right, so we covered this a little bit in 101. I'll go through it quickly here. Make sure that you are really only committing resources if you're required. I mean, the uniform guidance itself states that voluntary committed cost sharing is not expected and can't be used as a factor, right, in merit review process. So if it's not a requirement as part of the program, right, volunteering that cost share should not be used as the merit review. And then leverage, we're seeing this more and more. That's a demonstration of institutional commitment. It's not legally binding. It identifies the available resources to conduct the research, and it should be represented in non-monetary terms, excuse me. And if you can, make sure to indicate it's not cost share, right? And then here, really what I'll talk about is just, if you've got a case where the sponsor is restricting F&A, and which we would apply to our total direct cost base, you may need to do some math, because you may find that our organized, or I should say, sorry, our federally negotiated rate against the modified total direct cost base is actually lower. So we don't want to charge more in F&A than we are federally approved to do through our negotiated rate. And then you'll find that there are some tricky programs such as the USAID NIFA, which has you calculate on the total federal funding awarded, total costs, at 30%, and that includes the prime applicant F&A and all of the subaward F&A. So you have to do a lot of math there to make sure that you're calculating it correctly. And that's really all to say, make sure you get those budget elements in as early as possible, especially if you have subrecipients, because you'll need to work that out a little bit before you submit that budget. Okay, and then really quickly, we've got some sources of funding for transfers. This is when a PI is moving institution and is able to bring their research with them. The former institution really needs to start getting engaged with the sponsor as soon as possible, but do remember that granting agencies are making awards to the institution, not to the PI. So it's really the former institution's prerogative to allow that transfer. If they don't want to relinquish that award, then the PA may seek a sub agreement, right, to their new institution. There are several actions the RA of the incoming institutions should make, but really they just need to confirm at first, at least, the anticipated award period and the remaining funds. A lot of times it's on that relinquishing institution's obligation to initiate that process. We treat these transfer in proposals as new proposals, but they do generally take a little bit longer because you have that collaboration period with the relinquishing institution. Foreign sponsors, of course, we want to submit in US dollars if we can, for obvious reasons. Fluctuations in currency, of course, could leave us under budgeted. Also, there are conversion fees that often won't be supported by the sponsor, so that may fall to the unit as well. Value added tax, that I think in itself could probably take a whole seminar, but it's assessed on goods and services in certain foreign countries, and the awardee may be responsible for payment of this tax, though of course our preference is that it doesn't flow down. So during proposal development, make sure you check to see if the sponsor resides in a country where VAT is applied, and consult with your sponsored projects office, or if you have a global operations office, they may be able to help as well. All right, industry, academic and industry partnerships, of course, continue to expand. Industry has its own F&A rate, and it's generally not impacted by activity type or on our off-campus. Payment schedules are usually indicated at the proposal stage. Budget information here should be limited to a summary of loaded categorical costs, which we'll look at in the contract slide. And then work that's involving licensing or patent costs needs to be discussed with your IP office, and they'll take a look at the scope and budget and let you know what needs to be included for a technology administration fee. Charitable grants, all right. So the feds, they don't make charitable contributions, right? Government funding doesn't fall into that. And exchange transactions, excuse me, that have potential commercial benefit are also not charitable, but it may still result in a grant agreement. It may have financial reporting requirements or certain regulatory approvals. So if there is a charitable grant that's got a PI, a scope of work, or a budget, we will run those as sponsored projects generally, where that's distinct from a gift, which is unrestricted. And they often do contain very similar budgets or elements, right, to what we would regard as a federal or state other sponsored project. Do note here they will have their own F&A rate technically, and also because it is lower, normally will support items that would have otherwise been captured in indirect cost recovery. All right, mentioned the federal acquisition regulation. That's what governs federal contracts, just as uniform guidance governs grants and cooperative agreements. These are directed towards objectives for which the work, like basically can't be described specifically in advance, but are calculated based on the deliverables. The distinctions here, for cost reimbursement, right? That's what we generally prefer because it most closely aligns with our grants and cooperative agreements, but you will see sometimes that these contracts are issued as fixed price, which is a single sum essentially, right? So it does provide you with some flexibility to move costs around, but they are at higher risk because you may end up needing more money to perform the work and unable to do so, right? You are only given that fixed price cost. Oh, and then a quick note on labor categories. You may be asked to provide these labor rates or labor categories, and these are estimation devised on planned personnel, but that for an indefinite delivery, indefinite quantity, or IDIQ, these rates may actually persist through the life of that agreement, that IDIQ, and so you'll have to apply them no matter who is getting those task orders underneath. And then just really quickly, if you're dealing with contracts, here are a couple of things that you may face depending on the size of the proposal budget. Current costs and pricing data certification. And we have information on the slides here. I'll just move through this quickly, but with this and the small business subcontracting plan, really just be mindful of the fact that you're going to need a little additional time, right? And you're going to have those final budget numbers pretty quickly. With a small business subcontracting plan, if you meet that threshold over $750,000 and are required to supply it at the time of proposal, you want to make sure you get those final budget numbers about a week in advance because it does take some calculation. And also note that this is, despite the name, not specific to those proposals that have subcontracts as we know them. This is for any outside funding, right? It essentially applies to most of what is not personnel or remains within your own institution. So anything that you're paying for travel, services, supplies, and so forth, right, would be considered and reviewed to see if it qualifies as small business spending. So quickly in post-submission, you may be asked to verify costs. This isn't uncommon, especially with salaries and so forth. You'll have to share some HR information there. You may get your budget cut. The big takeaway there is if it is getting cut significantly, that the PI is actually evaluating their scope of work to see if it needs to change, that they're not just outright accepting it without any adjustments, of course, because presumably you are proposing your budget based on the needs of that scope of work. Some sponsors require an impact statement, but really if the scope is being impacted, it should be addressed, right, in response to those budget cuts. And then pre-award spending. Many federal agencies operate under expanded authorities, so they'll permit you to spend up to 90 days in advance of the effective date of the award. Just make sure you're familiar with those policies and that you're spending appropriately should you seek that out. It's called at-risk account because you are taking the risk, right? That the sponsor is under no obligation to award you, right? But you need to have a pretty certain assurance that they will, that there is some intention to fund. And of course, if it's not the feds, that does increase the risk a little bit. Make sure that you have as much backup documentation when you're requesting that at-risk account. Also, just a reminder that the regulatory compliance remains a requirement for award activation. So you may get approved for an at-risk account, but you can't actually activate that account until those requirements, such as human subject approvals or conflict of interest disclosures are complete. Okay. Now we're getting into that smooth transition to award.
So, and one thing that I forgot to, talk about at the beginning of the session is that this is a compressed session based on a much longer session. We'd adapted it to fit the time and also to highlight a little bit more on post-award and the impact of, pre-award budgeting. So I wanted to put that out there. We'll have a couple of case studies, but the most important thing to remember is that the more effort you put in pre-award when it comes to budgeting in that proposal, it's the easiest your post-award management will be. And a lot of what will impact the quality of that budget and budget justification is absolutely that relationship with your faculty, slowly but surely, helping them, not do rushed last minute proposals. Because I feel a lot of the times, and I've worked with a lot of faculty who are this way, and I used to specialize in last minute proposals. So not having the mentality of like, let's just put something on there to get this proposal out the door, because at the end of the day, doing that, it creates itself at risk because don't know if you'll actually have enough to deliver on all the promises the PI includes in that research narrative. So making sure that, as much as possible, working on developing those relationships with faculty or anybody else who bid in proposals, because it really does help, to get the right information at the right time. So some of those challenges that, as I mentioned before, that you face pre-award include, those rushed last minute proposals, not having a fully developed scope of work, or maybe, if it's a resubmission, using old budgets or old numbers that no longer apply, and also not having enough time to gather, the additional justification for the budget, including quotes from vendors and things like that. So when you have faced all those challenges pre-award, all of those transition over if that project gets awarded, because we're going to have to work with estimates instead of actual cost. So if your faculty decided to use an old quote or something like that at proposal time, and it was a rush proposal, your cost will be under when it comes to post-award. Also, another indicator of a weak budget or weak pre-award budgeting planning would be, constant rebudgeting, so working with faculty to try to see things long-term, and planning and meeting with them regularly. But again, I think that the biggest challenge we see post-award is not having enough funds to do what we said we were going to do. Constantly, things are more expensive than when we anticipated, F&A rates changing, ERE rates changing, salary basis changing. So that's another challenge that we see all the time. And also, a lot of the time, administrative staff trying to figure out how to deal and mitigate the effects of bad budgeting on proposal time. It's also very time consuming and administratively expensive. So again, some impacts of those pre-award and post-award challenges include the insufficiency of funds, disallowances, increased frustration, and also, and I see that this is additional funding requests, which, to be honest, I feel like a lot of sponsors are less likely to do additional funding requests now that they were like 5 years ago. But still, it has its impact on post-award. And I did want to take the time to give credit to Jolena Peck and April McCleary, who inspired this slide. Thank you. So to ensure a smooth transition to the award, there's also, and we'll go over it by categories, but for your personnel costs, making sure that, people are actually budgeted at the right position type. And we talked about this a little bit on 101, is the person going to be a temporary staff member? Is it going to be a full-time benefit eligible? So all of those things can have an impact post-award. So a potential strategy to minimize that impact on personnel is to avoid using TBD personnel when possible, or potentially, working with your faculty to identify whether it's a to be named, meaning somebody existing from your university, or a to be hired person who's going to be brand new to the institution. Other potential impacts for capital equipment include insufficient funds for unaccounted cost, like we talked about, not including installation costs, taxes, shipping, and things of that nature. So potential strategies to ensure a smooth transition to an award would include to talk to your post-award counterpart if you are doing pre-award, making sure that we are requesting quotes as much as possible, and maybe doing multiple quotes at proposal time if at all possible, and including those at proposal time. For subcontracts, I think that what I see the most is, again, administratively, it takes a lot to establish a subaward, especially with an institution your university has not yet done business with. So making sure that we don't leave all the documents that are required for a subaward to be issued to post-award, because a lot of these documents are not required for proposal, but a lot of people put it off, submit the proposal, and then forget about it until it becomes an issue post-award. So making sure that you're having the right communication with your faculty, making sure that they are connecting the subaward institution is connecting with your counterpart from the other institution, and that you are planning ahead and setting some expectations about how these documents should be received. Participant support, again, participant support is a restricted category. It is very difficult to budget out of participant support. So making sure that we are using participant support correctly at proposal time and also during post-award, making sure, because the potential impact is, audit findings, reduction of funding, and as we talked about before, maybe even the inability to use up those funds. So making sure that you're explaining risk to your faculty and that we're educating faculty in the right language to use. Okay, and then for cost share, I think that the biggest, and again, this is attitude changing over time. Cost share was, deemed desirable for a long time when projects are being reviewed. We still have faculty who remember those times, so they might be very eager to include cost share when it's not required, especially if it's not prohibited. They might be excited to do it. So making sure that faculty understand that ultimately, especially here at ASU, if we are committing a lot of cost share, it's ultimately the department. If they're allowing partner institutions or sub-award institutions to cost share, if they don't, follow through, then it's ultimately your institution's responsibility. Making sure we are highlighting risk, and again, making sure that we're understanding the requirements of cost share at proposal time, and also, following best practice of doing in-kind versus new cash, and also identifying those sources early on so there are no issues. But overall, a summary of strategies to ensure a smooth transition to award include absolutely be proactive, having those really good lines of communication with your faculty, being very diligent, and making sure that you are patient and flexible. Faculty do, like us, most of us have a lot on their plates, and we do speak a different language, and it takes time to get to that place of trust where they get you the information that you need. Next slide, please. Oh, case studies. So I have a couple of case studies, and I know I've worked at U of A and ASU, so please feel free to ignore any similarities to faculty or projects that but basically, and for this one is actually, it happened to me, and it happened recently, and it's still going on. But one thing is about that importance of having that trust and that relationship with your faculty so you can have more productive conversations at proposal time. I was working with a faculty member that I had just started working with that person, and I was advised to do just a budget. It was going to be an email submission. The budget was mainly for salary, ERE, and consultant travel. And the proposal got awarded, and now at award time we find out it was not meant to be consultant travel. It was meant to be participant support because we're hosting a conference. which is a different, interpretation of what I thought the project was going to look like at proposal time. So we have the impact of now having to recategorize, consultant travel to participant support. As the project keeps moving forward, now we are finding other things that, again, could have very easily been addressed at proposal time. For example, the faculty member had been collecting registration fees for this conference that they're hosting. So now there is a program income implication on the project. Aside from the program income implication, the funds that are being requested are being kept in an account that has funds from other sources. So there's all of these things. The other thing too that we're finding out with this particular project was that instead of doing catering, the faculty member wanted to purchase everyday household items to provide coffee breaks for people attending the conference. Tea kettle, a coffee maker, water dispenser, mugs, and things of that nature. And so again, all of these conversations would have been very helpful to have at proposal time. It would have been a completely different budget. It would have been a lot easier to recognize a lot of these issues post-award. But again, at that time, I did not have, I think the trust was not yet there, and we were new to working with each other. So we're trying to solve those issues moving forward. But one thing, because I feel that you can make a case for some of the expenses, like the household items, like, oh, it's summer, or like you don't want people to lose people's participation in the conference by having them go somewhere else and get a drink or whatever. But I think ultimately one thing that people need to keep in mind whenever you are either including non-traditional items in your proposal budgets, or when you are approving and purchasing non-traditional items in your post-award is, what would, going back to your cost account, your cost principles, like would a prudent person off the street who has no research administration knowledge think that this expense is reasonable? So would it be reasonable to say we need to buy mugs for a conference? Because then it might raise a lot more questions. What is going to happen after this? If this is not getting catered, are there any implications for health, or what happens after the end of the project? So again, this is an example mostly of not having enough information at proposal time, and not having that relationship with the faculty yet. Like now I speak that faculty's language, so now I understand, I know what questions to ask, but that was definitely a challenge. So again, program income is also one of those items that, again, it should have been included at proposal time. We should have said, how much we're going to charge, like all of these things. But also one thing that, that particular faculty is still learning is that just because you are collecting program income, it doesn't mean that you will be able to use that program income account to charge anything and everything. Program income is still, part of your sponsor project. It follows the rules and regulations of, the sponsor that gave you the source of funding. So again, there is a lot of training. And I know we have not a lot of time, but if you do have questions as I go through the case studies, feel free to put them in the chat, and we can answer those as we go, just because we didn't have a lot of time for questions on the other session, and for this one we did. The other case study I have is about, and again, highlighting the importance of, asking those key questions at proposal time, is when faculty have a planned change in role or institution at proposal time. We had a faculty member who was part of a multi-institution collaborative proposal, 3 universities, 2 faculty members and 1 postdoc about to become a faculty member. Proposal got submitted, proposal got awarded, but the postdoc who was about to become a faculty member, first of all, they had a very small role in the project. And also they had planned to go become a researcher for a governmental agency by the time the proposal got awarded. So the lead institution's approach to handling, all of those changes, which they all knew about, at proposal time, was to rebudget the postdocs portion of the budget and give it to ASU. Because to them, it was not really considered a change since, ASU was going to receive a sub-award anyway. And so they are focusing just on the rebudgeting part of it when it truly is a change in what it is and what the project was meant to do. And so it is, again, one of those conversations where, would that postdoc been better off being listed as a consultant? And so one of the things that for me, as I continue to work with some of my faculty, is making sure we have those conversations and asking the right question. Because right now for us, the lead institution is okay without letting the sponsor know about these changes, which I consider to be major changes, because it's different resources, it's different role, is different, is just different. And also one of the solutions proposed by the lead institution was just to have ASU, who was a sub-awardee, issue their second tier sub-award to the other institution, which also does not make sense. So again, a lot of red flags, based on, lack of information on proposal time. For that one, I take less of responsibility because, it was a lot of the lead institution. But again, I just now helping that faculty have those conversations with the lead institution and be like, hey, we can just do this, because changes in sub-awards and scope of work are big, and they're red flags, and they're they increase our audit risk. Okay, and then for the last one that I think I can fit in, and again, if it's this one is for international projects. And I will say this, that I feel that at least here at ASU, the landscape of how we do international projects is changing, in the sense I feel for a while faculty were very intrigued in the pursuit of international projects and would absolutely try to do the best of doing very low budgets with ginormous scopes of work. I think that culture is shifting a little bit now, where they are trying to just do, budgets that make sense for the scope of work. We're not trying to undercut, how expensive it is to do research, especially in other countries. But some of the things that I see frequently that impact from pre-award, that impacts post-award with international projects, is lack of sufficient staff. We had a project where, the project director was also technically, expected to serve as a research administrator and also provide capacity building for the foreign institution. There was also some changes in project personnel during execution that required, recruitment of new personnel, and there was no, recruitment costs included at proposal time, even though these are very highly technical and specialized positions. And then one thing that we've also seen with some international projects is that we create at proposal time some staff and faculty salary pools, so we can use subject matter experts across the university at any given time without committing them to the project overall. And so for us, that particular pool became something that needed to be paid out as additional pay. Since we did not address it at proposal time, we did have a little bit of a challenge getting, approval post-award from the sponsor, especially because for us, and it's a USAID project, USAID doesn't want to weigh in on day-to-day things, even though per, terms of the agreement and uniform guidance, they're supposed to weigh in on things. So it makes a challenge. And so again, just to bring it back to what we discussed in the other session is, making sure that we're asking for what we need. Making a project cheap does not make it better or more desirable. And, ultimately, we're looking out for the institution. And I don't think we have 1 minute. So if people have any questions at all, like we mentioned before, materials will go out soon. But thank you everyone for your time. And we do have some additional resources for all the institutions that will be included with presentation materials. I'm on LinkedIn, I'm on Teams, I'm on Slack, I'm everywhere. If you have questions, I'm always happy to hear myself talk.
Excellent. Thank you, ladies, so very much. Sarah and Samantha, thank you very much for all that information. Truly an awesome presentation. So just so that all of the participants are aware, the link for the end of the session survey will be sent to you, but you will have to copy and paste it in your browser in order to actually initiate it and go off to it. So if there are any questions, I see a bazillion thank yous to the two of you for all of the information. Otherwise, we'll just kind of wait a sec and see if there's any questions. Otherwise, truly
Rachel,
awesome.
can I ask a question?
Oh, hello, Christina, please.
Hello, my love.
Hello.
So for the earlier ones, nobody ever told us we needed to copy and paste the link into the browser. So literally I just closed the tab because it just didn't work for me. I didn't have any questions. So can those be resent for the morning sessions?
I don't know. I will check with the other monitoring folks and see if we can do that.
Okay, just if you need anything from me, just let me know.
Yes, ma'am. Thank you.
Thank you.
All right. Yeah, still all the thank yous. All the thank yous. Yay. Well, excellent. We shan't sit here and stare at each other any longer. If there are any questions, please feel free to reach out to both Sarah and or Samantha for further information. And yes, Angie has said that we can send out the evaluation survey links eventually as well. So yay, all the answers to all the things. So thank you everybody for joining us. As Samantha said, this information will be shared later on, and have a lovely rest of the TURAC.
Thank you.
Thank you guys.
Bye, guys. And thanks, Rachel.
Thank you.
Thank you.